Today's episode is brought to you by Bit.com. You'll be hearing more about them later on in today's interview, which begins right now.
I think that's my message about the markets. There will be money to be made on the upside and on the downside, but BBC, be bloody careful. This is not the world of the last 20 years. It's the world of your granddad. And he'll tell you it wasn't necessarily plain sailing.
Very excited to welcome back to Forward Guidance Paul Hodges, chairman of New Normal Consulting, author of the PH Report. Paul, great to have you back.
Well, thank you very much for having me.
It's my pleasure, Paul. The last time we spoke, it was roughly a month ago. You were very worried about what was going on in Europe, that the commodity price shocks would cause a recession. You were noting that the renewed hawkishness from central banks globally were causing an asset price collapse. I think it's fair to say, Paul, that both of those fronts have gotten far, far worse in a very short amount of time. Just give us a sense. What have you been seeing in the markets? Tell us where you're at.
Well, I think we're seeing two things, really. If we look at the central banks spent 20 years believing that Alan Greenspan and Ben Bernanke were these wonderful super bankers who could mean that you never, ever had a downturn. Or if you had a downturn, it was only 5 minutes and you passed on and nothing to see here, move along, please. And so that was 20 years. And what's interesting is that in the last few weeks now, you don't hear any central banker talking about Alan Greenspan or Ben Bernanke. There's only one central banker they talk about now, which is Paul Volcker. What did Paul Volcker do? Paul Volcker, helped to bring inflation down from 15, 20%, depending on where you were, to where we got to. And how did he do that? Well, he didn't do that by supporting the stock markets. In fact, if you go back to 1980, 1982, he said, you've got to get inflation down. We shouldn't have let it get to this point. So it's going to be fairly brutal. And that's what he did. This idea that the central bank is there to look after financial markets and, to paraphrase that great phrase about General Motors, what's good for financial markets is good for the economy. Well, that has been revealed to be pretty much nonsense, as some of us thought all the time. But it's more important that it's now revealed as that. So we're now into this downturn. And the problem is, and you can't blame the central banks for all of this, but you can certainly blame them for a lot of it, is you've now got an awful lot of debt. And the one thing that Volcker didn't have to deal with in 1980 was debt. There were lots of things that were wrong with the economy. One could go into that if you like, but we didn't have governments in vast debt. We didn't have central banks with overloaded asset balance sheets, and nor did we have personal income really overcome by debt. So we've got a major problem there. What we've also got is what I would call the three horsemen of the apocalypse. And again, you can't blame central bankers for this, but we had the pandemic, which is obviously the plague. We're now in, that's still going on. I mean, look what's happening in China. So we can't say that's finished by any means. We've got war, the Russian invasion of Ukraine, and I'm afraid it's more or less certain we're about to get to famine, because the Russian invasion has pushed up energy prices, particularly gas prices. Gas prices go into fertilizer. About half of the world population, according to Our World in Data, are actually kept alive because of nitrogen fertilizers. They say without nitrogen fertilizers, you could only support about 4 billion people in the world instead of today's 7.9 billion. And fertilizer prices have rocketed from $200 to $1,600 a ton, and farmers can't afford it. And of course, that's going to push prices up for food and so on. We're already starting to see that in the supermarkets and so on. So you can't blame them for that. But what you can do is say, well, you could have had the economy in a better state before this happened. But you're in a world now which is very much like the 70s. So you've got high energy prices, you've got high interest rates, you've going higher. You've got high inflation, you've got geopolitical tensions, you've got nuclear risks, a whole series of things that you had in the 70s. And the point, I suppose, is that public opinion doesn't expect you to do nothing. Are you going to sit here and keep interest rates at 2 or 3%? And actually, if we turn it around the other way, what would happen if central banks did that? Well, anybody with any money would say, this isn't much fun of a game of soldiers. I'm not going to lend my money. And so the money markets would start to take a life of their own, which is indeed what happened before Volcker came along. We had phenomenon called the bond market vigilantes. And the vigilantes basically started to push bond prices down and interest rates up because people, like ourselves, if we had any money, which isn't, of course, like ourselves, but if we were, let's think of those glorious days, if we had, we would say, well, why would we lend at 2 or 3% when inflation is 8.3%? There are lots of ways of losing money, but that is a pretty guaranteed way of doing it. So whichever way you look at it, interest rates are going up, and they're probably going up a lot more than people expect. I mean, we would expect them to go, not overnight, once they get through about 3.25%, then we know we're back in the world of real interest rates, if you like. And probably if they do go over 3.25%, they'll go very quickly to 5%, and I wouldn't rule them out going to 10%. And in the middle of that, of course, you'll have a housing crash. But we've been here before. We know how it works. All one can do is explain to people this is how it works, and if they see a flaw in the argument, then I'm delighted to hear of it. But that's normally how it all happens.
But Paul, well, I guess what I'm trying to ask is, to what degree, if the inflationary shocks are on the supply side, do interest rate hikes, does quantitative tightening have any real supply on that? Like just to put a point on it, would hiking interest rates from 1% to 6% overnight, what would that cause the price of ammonia to go back from $1,600 to $200, or is it sort of outside of the realm of the Federal Reserve's control?
Well, I was at a meeting a couple of weeks ago in Germany with Joachim Nagel, the new president of the Bundesbank, and what he was saying, and John Williams of the New York Fed was there as well, is that you've got to tackle supply and demand, because you've got both things going on at once. So you can argue, and to a certain extent it's true, that supply shortages are unconnected with interest rates, but not really, because supply is being driven by supposed demand. So if demand drops, then supply will start to rebalance. So what you've really got to do all the time with interest rates is they really hit demand. They don't hit much on demand, on supply immediately, but they have an indirect effect. So if you reduce demand, then you will see that supply starts to rebalance just by logic.
Right. And Paul, you have been a student of supply chains for a long time. Why are supply chains still messed up? Do you see any hope going forward that supply chains will return to a sort of a normal, globalized, efficient market where we won't have all of this volatility in the prices of goods?
I turn your question round a bit, Jack. I think we're going back to a world where we don't have supply chains anymore. We have what's called distribution. And what I mean by that is you had the baby boomers. The boomers in the 70s and 80s created fantastic demand, as we've discussed in the past. You had a 52% increase in the number of babies born in the States between 1946 and 64 compared to the previous 18 years. Well, if you have a 52% increase in the number of babies born, in a certain amount of time, not the day one, not day two, but certainly 10 and 20 years, you start to get a fantastic increase in demand. So that's what you did. The only way you can ration demand, if you can't build supply fast enough to supply it, you have to ration demand by higher prices and higher interest rates. But then what happened, and I was part of this in the late 80s and the 90s, was you said we need more supply. And it was quite clear that demand was growing every year because all these babies were coming into that 25 to 54 wealth creator period, and they were having their own babies, and they were buying houses, and they were buying cars, and so on. So you needed more stuff and more stuff. So you had to globalize. And so that's when we went from distribution, making it in Chicago and selling it in Chicago, or if you like, in Illinois, if you want to go excited, and you said, no, we've actually got to do global supply chains. So I had 12 in my business in ICI. I had 12 business development people around Asia Pacific, and we were building plants as fast as we could in order to supply back. But we haven't got a young population anymore. We've got an aging population. So we don't need globalization anymore. We don't need all this stuff. We've got a hiccup at the moment because we were set up for this, and then COVID came along, completely changed demand patterns, and meant that with the lockdowns, that you also all the long distance supply got messed up. And then, of course, you've got a third element. I always regard these things as a bit like you throw a stone in the pond, and the first stone you throw is COVID, and you lock people down and so on. And then you throw another stone in the pond, and because you've locked people down, you now aren't getting too much supply coming out because factories are shut and ships are quarantined and all of that sort of stuff that we know about. And then you throw a third stone in, and its ripples start to hit the ripples of the other two, and now you've got customers, for example, Target and Walmart, saying, well, we better move from just-in-time supply chain to just-in-case. You can't rely on everything arriving. We ordered it from Shanghai. It should have been here last week, but it hasn't come. In fact, it hasn't come on schedule now for over a year. So we better order more. And so at first you see a lot of apparent demand because people are ordering more and more. And so the prices go up because people say, well, there's fantastic demand. But it wasn't really actual demand. It was people buying just in case. And last week we saw the denouement of that with both Target and Walmart. And you can't get better retailers than them. It's not like saying this is Farley and Hodges who just don't know what they're doing. In this case,
Farley and Hodges, we've got to go on bitches, Paul.
But to be frank, we could have done better this time round because they made such a mess of it. It's unlikely.
Well, I couldn't have, but with you on board, we definitely could have. So Paul, I was at my company's Blockworks crypto conference last week, permissionless. So it must have taken a pretty intense sell-off in traditional finance markets for me to pay attention. But I'll say, right in the middle of crypto conference, I did notice that Target fell 30% in one day. Even I noticed. So just tell us why is it that Target is down 30% and the business is really suffering? You have a blog post out called U.S. stocks set for long-term decline as Fed pivots to focus on, quote, Putin inflation. Why is inflation bad for stocks? I can make the counter argument and say, Paul, if the prices of things are going up, who sells things? Companies. They're going to make more money. Why is inflation so necessarily bad for stocks, in U.S. stocks in particular?
There are occasions when it can be good news. Usually at the start of a sort of inflationary cycle, because at the start of an inflationary cycle, what you see is people ordering more because they know prices will be higher tomorrow. We see this in the oil market all the time. Every time the oil price doubles, which seems to be most weeks these days, people rush to buy a bit, and then they discover, oh no, we're not actually. They've got a call from the salespeople saying, well, we haven't sold anything, Gov. So there's no point in buying any more, and so they destock. And so you have a sort of boom bust mentality, and that's going to continue. We're in a boom bust mentality, but what the underlying picture here is you've got this thing which I think was the president of Lithuania came up with the term of Putinflation, a play on Putin and inflation. because what the war has done is it's pushed up all energy prices, it's pushed up fertilizer costs and therefore food prices. And this is because energy costs go into everything. You don't only heat your home and transport and everything else, but all the things that you have around you, including chemicals, obviously, and plastics and so on, they've all got an energy component. And so if you're in that kind of world, what you're now seeing, to go back to my analogy of stones in the pond, is you've got lots and lots of ripples happening out there, and they're jumping into each other, as it were, and causing more ripples to form, and nobody can quite work out how this goes. But the end result, the key answer to your question, is everything becomes less affordable. So what you're seeing now is you're seeing in markets, for example, you're seeing fuel versus food. Should we be having bioethanol going and biodiesel for our cars, or should we be using that land to grow ethanol for food? Similarly, people going to the shops, and there's an awful lot of anecdotal evidence about this from the big retailers around the world, shoppers going in, and they've got to choose between heating their home or eating. And that's what does for equities. I mean, I'd say that there will inevitably be some sectors of the market that buck that trend. I mean, defence is an obvious one that could do well for the moment. Certainly, if we go back to our rotation theme, what you saw was that all these very naive investors in 2020 spent their furlough money on options with our friend Barstool, putting them into complete rubbish stocks, and those rubbish stocks all fell apart in the end, as rubbish stocks do. People didn't say, oh, wait a minute, this isn't a good idea, we better think about this a bit. They said, no, I just got into the wrong stocks, I need to get into the FANGs. And so you get a final hurrah. This is Bob Farrell's rule, I think, number 4, of the public buys the most at the top and least at the bottom, which of course is how you can tell it's a top. And so they all rushed in, and they all bought Apple, and they all bought Facebook, and they all bought so on. And then, and I mean, knock me over with a feather, but who would believe that if you weren't locked down anymore, and if you weren't therefore having to watch more and more television and trying to keep the kids amused and so on, and your cash was getting a bit tight now because you'd lost your furlough money, who would believe that you might cancel the Netflix subscription? Oh, nobody would have thought that happened. Dear, oh dear. Well, then it did. And then people said, my goodness, this is extraordinary. And obviously, I mean, nobody could have thought of this either. If you're not you're having to be at home and you're actually able to go out to the shops, who would have thought you'd buy less from Amazon? I mean, obviously, that's quite... And equally with Apple. I mean, obviously, everybody's always going to buy Apple phones, but supposing you can't get Apple phones anymore because of Chinese lockdowns. So in other words, what we're seeing is reality starting to come back at a very, very slow pace. And of course, the market is already down 20%, near enough, bouncing today, because lots of people say, well, it's down 20%. Obviously, that's the bottom. Well, I've been here before, and I can tell you that, that this is the second most valued, highly valued market in history, according to Robert Shiller's CAPE index, which is a cyclically adjusted price earnings. So it goes back to 1881. It's on the blog today, and the blog is free, so anybody can go and
we'll put a link. Yep.
Yeah. So just go to new-normal.com, go to blog, and have a look. So there is the chart from Professor Robert Shiller of Yale, got a Nobel Prize for this work, so he's pretty good. And it showed the highest valuation was 2000, after which NASDAQ came down 80%, as we know. The second highest valuation was last year. It was higher than in 2008, and certainly higher than anything else. So we are kind of going to come down. The normal valuation, we were at 38 last year. The normal valuation is about 15. So we are, if you came down by 50%, you would only be coming down to an average valuation. But of course, you never markets don't just go to a nice rational thing. They always overreact. If they've gone too far up, they come too far down. So there will be a buying moment, but it will probably be about 2024, 2025, with one proviso, that this rotation theory, which we've seen many times, so it's not something that we need to sort of say, oh well, I'm not sure that will happen. People get to a certain down point and they say, no, that must be the end now. And anyway, this is this great new opportunity. And that's why you get some of the strongest rallies in bear markets. You can see markets going up 50% sometimes only 10%. And I suspect that this time round, some of the rallies will be very sharp indeed, because after all, you haven't got many individual investors anymore. You haven't got many who are buying their own stocks. What you're doing is you've got people buying exchange traded funds, and of course you've got 60 to 70% of the market run by algorithms. So if there's a headline there, the New York Times or the Wall Street Journal or USA Today or something, boom, in they go, up it goes. And so you'll get these very sharp moves, and of course people will then follow with that, and then it will collapse again. So it's going to be, there is money to be made in these markets, as there's money to be made in any market, but it's a market where you've got to be very cautious, because what you see is not reality.
Paul, first, I want to divide the market into a few subsectors. First, I want to ask you about probably the most beleaguered sector in the market, which would be the hyper-growth, unprofitable technology stocks. So sort of the poster child for this would be ARKK, that ARK Invest ETF. A company like Tesla, although Tesla is actually profitable, but maybe companies that are pre-revenue in some cases, like Virgin Galactic or QuantumScape, QS, companies where they've told you that they're not going to make any money until 2025. And I'm talking about revenue in the case of QuantumScape. Do you think it's game over for those type of companies?
Well, the question, why is Amazon still with us today? Because in 2001, I think it was, they had a very good CFO who realized that they were about to go bankrupt, and before they did, raised a bucket of money and kept them alive. So, so it's foolish to say that all of these companies will go bust. But the one characteristic that you can tell when a company will go bust is when they fail to recognize that the zeitgeist of the world has changed. So what was incredible to me last week, but actually a very good signal, was that I think 26 billion or something went into ARK. Now, that's plainly stupid, right? But it shows you there are still lots of people out there who want to double down. And they say, well, I didn't see it coming that this was going to fall, but obviously it's a mistake, so ARK is going to go back up again. And so this is a very good signal that people are saying, oh, 20% down, we must be capitulating. Guys, I cannot see any reason in the world for investing in ARK unless you happen to be a momentum player. It's just business model and everything else just makes no sense to me whatsoever. If you look at Tesla, I can see some reason to invest in Tesla. He's making some cars. He's got, for the moment, a bit of a cash cushion because he can sell emission rights to other companies. And I believe in electric vehicles. And as far as I know, the people I've talked to, they all like driving Tesla cars. So he's got some pluses there. What we don't really know is what's his break even for all this. How will this go? Is he really able to manage it? But what we do know is that he is not going to dominate the EV market, because GM and VW and Ford and all the others are very good at this game. And you're playing against people who've done this for 100 years. So it's very unlikely they're just going to give up, because they've noticed what's happening and they've been at it now for 5 years themselves. They're catching up quite fast, and they've got a lot of resources. Most definitely resources. They've got the income from gasoline and diesel sales, which is very high. So they can afford to do this. They don't have to go to the market to borrow more money, which is what Tesla's done. But the other problem with Tesla is people say, well, not only is he going to dominate and control the entire electric vehicle market, he's going to dominate and control the entire autonomous vehicle market. Far, far more difficult than that. Oh, and is going to control all the world taxi market. Now, at that point, you've got people have taken leave of their senses. If you sat down with a pencil and a piece of paper, you'd say, well, what kind of market share do we think that Tesla could get over the next 5 to 10 years as competition develops? Could it get 5% of the market? Probably could. It does a reasonable job. Could it get 10%? Stretching it, because you've got an awful lot of competition coming at you, particularly from China. But maybe it's in the 5 to 10%. Then you've got to say, well, how many cars, and so on. You've got to do some basic analysis of how many cars can he sell, what's his cost base going to be. Pretty difficult to work that out today because costs are going up all the time. What's the impact of autonomous vehicles? All I'm saying is, if you want to get a valuation for Tesla in today's market, you've now got to go back to what a chap called Ben Graham would be talking about.
Graham. Who's that?
Ben really, yes. Remember Ben Graham? Ben. Barstool Harry said, roll over Warren Buffett. I'm the new Buffett. Well, yeah, he was for about a week, but he isn't anymore.
Nope.
And Warren's claim to fame is that he studied under Ben Graham at New York University. Ben Graham was the guy who invented securities analysis. And his view is that the price of a share depends on the earnings over the next 10 years. That's the timescale on which you buy a share. It's not what the market, are you a bigger fool than me? Can I sell it to you for 50% more than I bought it? No. Those markets happen. We've seen those markets, but that's not how they're going to work now. So somewhere in there, you can do an analysis of Tesla, and you'll probably come out with a valuation. I think we did it the other day of around 70 or something. It's not that high, but there is
$70 per share.
Yeah,
that would be what I don't know what the price to earnings ratio is now. Something close to 100. So that would be closer to a price to earnings ratio of something like 15, right? Something around there, right?
Yeah, so it's a blog post from the 6th of February. So if you look at Tesla, at that time, 6th of February, it was priced at 923. I was slightly out on its Graham price, because the Graham price would be 53. So it was 1,797% overvalued. Amazon was 573% overvalued. Netflix was 452% overvalued, not quite so overvalued now. Microsoft was 303% overvalued. Apple was 337%. I mean, you're kind of getting the picture here, aren't you? Google was 300%.
Right.
Facebook was a mere 202% overvalued. And Ben Graham, as I say, was the mentor and tutor of Warren Buffett. So there's something quite important about that. And like all great things, the helpful things, it's actually relatively simple. You think of 8.5 as your base case, and if you're really sure that it's going to grow at 1% for the next 10 years, you give it a 10.5. And as interest rates go up, you'll change that around. But it kind of gets you in the ballpark. Should you be paying, 500 for this? Well, probably not.
I've got a problem. I've got a serious problem to propose to you, Paul, which is that the value stocks of today, copper miners, oil drillers, energy service companies, low quality earning retail companies, shipping stocks, they're all overvalued based on Ben Graham's thing. There's nothing, it's not, Apple and Tesla are overvalued, and then there's this pristine world of appropriately valued equities. Nothing's in the ballpark, Paul.
Well, but what else could it be, Jack, given that this is the second most overvalued market in history?
Yes.
You start in 1881 and you get to 2022, and the only market that has ever been more highly valued was in 2000. And we know what happened in 2000. So
yes,
We therefore have to assume it's going to be a long and painful route down, but we're going to get people like yourself coming in and saying, "Oh, look, we're down 50%. That's more than enough. Look, these stocks have got great opportunities now," and you'll get rallies. You'll get relief rallies. And I wouldn't discourage people from playing those rallies. I'd just say, be very careful.
Today's episode is brought to you by Bit.com, a leading cryptocurrency trading platform. From spot to futures to options trading and more, Bit.com has it all. So whether you're a seasoned investor or you're new to the game, you need to be on Bit.com. Bit.com has launched a zero taker fee option campaign until May 10th. To enroll, email VIP@bit.com. That's bit spelled B-I-T. So email VIP@bit.com and tell them I sent you. And how are you handicapping, Paul, the odds of a recession in Europe? The last time we spoke, you said that the huge surge in commodity prices, particularly natural gas, would cause severe demand destruction in Europe, particularly in countries like Germany that are heavily dependent on Russian natural gas. How has that played out over the past month? What are you seeing?
Well, I think there's no doubt that Europe is in recession
right now.
Yeah, and I would say that China is probably also in recession as well because of the lockdowns. So 2 of the 3 major economies in the world are in recession. The US was was negative growth in Q1. Whether it scrapes through in Q2 or not, I don't know. But the US is not going to be on its own here, somehow head above water when the rest of us are drowning. So you've already got a fairly weak economy. The sign of the economy is around asset prices and asset price inflation. So you've had 20 years of the European Central Bank, just like the Fed and just like China and so on, perhaps a bit less with China, saying, what's good for asset prices is good for the economy, which of course is complete nonsense. There's no connection between the two. What you've got, therefore, is a complete disconnect between the financial world and the real world of the economy. And what you found is that, if you own a house, you're very, very wealthy. If you've owned some stocks, you're very wealthy. But you are asset rich, but cash poor. And this is an important concept, that you can talk to people who live in what are valued as quite expensive houses, but they haven't got very much cash to spend, particularly if they're older and they're living on a pension now. That's that. So you've got to distinguish between the two. And if you look now at Europe, what we're seeing is that exactly those two things happening, but people are having to choose between heating their home and feeding themselves. Now, some governments have been more sensible than others. France, I think, limited energy price increases to 4%. The UK pushed them up by 100%. Well, clearly the UK goes straight into recession on that, particularly because they're talking about putting another 100% rise in October. This is just stupidity. But what would you expect from the government you've got in the UK? You've got some more sensible policies being in France and Germany and elsewhere, but you've got this overwhelming problem that you've got the 3 horsemen. You're still really not recovered from the pandemic. Nothing is as it was in 2019. You've got the war, which is pushing up prices everywhere, and you're going to have famine. So and this is the thing about the higher energy prices is that this doesn't happen in the click of a mouse. We're eating the food today that was grown with fertilizer and crops planted 6 months or so ago. Now we're in a situation of, well, can the farmer afford to buy the fertilizer and the seeds and so on in order to plant the next crop? Can the farmer afford to feed his animals? The IMF has talked about this now. The World Bank has talked about it. The World Trade Organization. I mean, there were some discussions today, which people will probably see, some really apocalyptic warnings about famine. Because if you look at Ukraine and Russia, just on the simple case of wheat exports, they're 29%. of the world wheat market, and the Black Sea is blockaded. So none of it is getting out, even if there were people farming, and even if they were able to afford the fertilizer. So somewhere like Egypt, which imports I think 80% of its wheat, isn't getting wheat. So the bread prices are going up, and so on, and this whole area is knock-on effects like this. So it's very definitely Europe is in recession, and it's very difficult to get out of this.
Is there any hope of agricultural products that can come onto the market? I know you're somewhat optimistic, or you were a month ago, about natural gas that could come from the United States. It could be turned into liquefied natural gas, put on tankers to Europe, then regasified there. How is that looking? I know you said that you wanted Olaf Scholz to the German government to do it by November of this year, but that it would require a Herculean effort, somewhat similar to what was required during World War II. Have what you've seen on the ground since then, has that given you hope, or are you less hopeful?
Well, it was interesting. I was in Germany with a lot of financial people and others, and the economics minister, Robert Habeck, was getting very, very high ratings from everyone, although he's a Green. So I think this was quite interesting that, this is a guy who came in saying we must get rid of fossil fuels, we must get rid of and so on. But he's actually, almost the first thing the poor chap had to do was to go out to the UAE and say, excuse me, sir, could I have some natural LNG? So he's being very, very pragmatic. And they've signed contracts now for to buy the LNG carriers that I talked about, which you can degasify. So you can't literally by November, build degasification. So even if you wade through all the environmental approvals and everything else, you just physically can't do it. But you could moor LNG carriers there and do it that way. And they are, they're moving as fast as they can. They've signed contracts for those and so on. So it's just a question of, can you physically get it all done in the time? So there's a lot of things, but remember that is not a return to where we were. That is simply trying to ensure that things aren't as bad as they might be. And there is a knock-on effect, of course, which is one of the things that's happened. And people in Europe are very grateful to the States because the States has made available all this LNG, which has pushed up natural gas prices in the States. So Europe is down. Europe is filling its gas storage like mad at the moment. So it will be at sensible levels and secure for a normal winter by September, October, without any doubt at this point. But at the same time, what that means is that the States is suffering from higher gas prices, and Asia is, because normally what you get is a modest flow of LNG from the States to Asia. Now that's obviously had to be cut off. And again, Europe is very grateful to Japan, who have said, no, that's fine. You need it more than we do. Go ahead. The Western democratic world is really working together here, and we are sharing the pain, which is fantastic. Really one needs to acknowledge that. But it isn't painless.
So you just to be clear, you said that Europe is filling its gas storage tankers like mad, and does that mean that Europe will have enough natural gas for the winter?
Basically, what you have to do is you have to build storage during the summer months when demand for natural gas is low, because demand in the winter gets very high. So and the other problem you've got, of course, is that you've got oil embargoes coming along. And it's very clear already that the Russian oil is not only being embargoed by some countries, but is also being embargoed by insurers, because they're not sure. If something goes wrong and there's a claim, was this legal shipment and so on? By
insurers for ships, you can't insure a Russian ship because what's going to happen? Yeah, that makes sense.
That's right, and so on. So what you've got is you've got a reasonable chance of having sufficient gas storage in Europe for a normal winter. Now, we were jolly lucky last winter that we had a warm winter, very few very, very cold days. The great Sod's law suggests that you may well end up with a colder winter, therefore, this time round, which would require higher. But the main issue you've now got is you normally are able to balance oil and gas supply and coal. Now again, Robert Halbeck has gone out and he's bought coal. He bought coal from anywhere, right? So everybody's doing the sensible, pragmatic things. Sorry about CO2 emissions. Sorry about all of that. Yeah. But if people freeze to death or starve to death, that doesn't. Well, it does help global warming, but it doesn't really. If you like. So
yeah, I mean, he bought a ton of coal, something like 2 billion cubic feet a day equivalent of coal. I mean, and this is someone who this is the German party had been banning nuclear power, and now they're embracing coal. I mean, this just goes to show how quickly the situation has changed.
Yeah. So what I'm cautioning against is that my guess is that there will be an embargo and sanctions on Russian oil and gas at some point, and that if there isn't, Putin at some point in September, October will stop supplies, as he's already seems to have done with Finland at the weekend. Putin knows when he's got a card in his hand, and he will play it. So we can't assume that Russian oil and gas will be available in the winter when we need it. So how do all the balances work out? Well, we don't know yet. There's a tremendous amount of uncertainty, and maybe you will overstock in some areas. Well, who cares really? I mean, this is not just national security. This is life and death. And
so, what is causing the European recession? Just to be clear, is it the high natural gas prices, and how is that manifesting? Is it demand destruction? What's going on?
Well, we've already had high oil prices for 18 months now, and we know that high oil prices, once oil prices get above around 3% of global GDP, you almost inevitably get into global recession. Because what you're seeing there is that people have a certain amount of discretionary cash to spend, and if oil prices are low and they don't have to spend very much on driving to work or acting as a taxi service for the kids or heating the home or keeping that home cool, then they've got more money to spend on things that drive the economy. But if the oil price is high, this is the 1980s and the 1970s teaching us, and we've seen it all the way through since then. If oil prices are high, that money goes to governments who don't necessarily spend it. And in the meantime, the people who would be spending it, they haven't got any spare discretionary cash, so they have to cut back.
What do you think are the odds of a recession in the US?
85, 90%.
And when do you think it will come?
You're at the point of over 3% of global GDP being spent on oil. And of course, we don't normally look at gas prices because that's not so important. But today it is, because gas prices are very much higher. I mean, natural gas, not gasoline. So you've got very high oil prices and you've got high natural gas prices. So that's one thing. Secondly, you've got a recession in Europe, you've got a recession in China, and you've got an enormous amount of debt, and interest rates are going up. So how do people pay those debts? Debt is essentially you bought today something you didn't need till tomorrow. It brings forward demand. Now you can argue with a house, that's sensible. I know I'm going to need a home for the next 20 years, so it makes sensible to buy it forward and take out a mortgage and so on at a sensible rate. May do that with a car at a sensible rate. But credit card debt's a bit different. You're paying a very, very high interest rate for what? For something you consume and finish with. That's So you've got a problem with spending habits here, that people have been used to being able to roll over, and there's always another credit card offer, and I can swap it over, and so on and so forth. I'm not being pejorative. This is something I've done myself, so I'm not saying I'm holier than thou. I know the syndrome, but I also know it doesn't work out well. At some point, it all goes wrong, and that's the point we're at today.
Right. Paul, I don't know if I'm going to disagree with you, but I want to ask you about your time horizon. And is it possible that a U.S. recession is something that's more in the 12 to 24 month range? Because when I look at, let's say, credit card spending, up until very recently, the U.S. consumer was at a point where banks had a problem. People weren't borrowing enough. And I think now we're at the point where borrowing is going up, but it's not, there aren't huge defaults. Likewise, just very, simple analysis is that the prices of housing is still going up. And typically, like, the price of housing doesn't have a blow off top where it surges higher and then immediately crashes. Typically, it sort of peaks, crests, and then goes down. So is this a 6 to 12 month story for you, or a 12 to 24 month?
Well, I think it's a story of probably the housing market sort of 3 to 5 years of at least to readjust, because there's a number of indicators that are lagging indicators. Employment is a lagging indicator. Everybody says, "Oh, we've got fantastic employment numbers. Isn't that great? So therefore, we can't possibly be in a recession." But actually, if you think you might need workers tomorrow, you hold on to the ones you've got, and if you think you're going to do well, you hire some more people. It's only when the demand hasn't come through and you realise that actually, it isn't going to come through, and I've got a cash problem here, that you start to lay people off. So unemployment is not very helpful at this stage of the cycle. It can look absolutely fantastic. You normally go into a recession with very low levels of unemployment, well, which is where we are today. If you look at housing, what you see is that the volume of houses on sale over the last 2 years has been relatively low. And the other point is that when you look at the monthly payment, what you're looking at is two numbers. You're looking at the interest rate and the capital cost. Now, if the capital cost is going up and the interest rate is going down, which is where we've been for 15 or 20 years, then you can argue to yourself, well, I'm never going to have to actually pay back that capital. All I care about is being able, can I meet the monthly payment?
And sorry, Paul, just the capital cost, that is how much the house is worth.
Exactly. So if the house, if the average house is whatever it is, $450,000 or something like that, and I'm paying 1%, you're a genius, Jack. You could do the sum about what that monthly payment is going to be. But and so if it's 450,000 and 1%, or it's 200,000 and 5%, actually, I think I'm right there. My payment of the 1% rate will be lower, even though the house price itself is higher. Wonderful. And because of that, I can borrow and so on, and I've got my credit cards and everything else. Life is lovely. What happens, however, when mortgage rates double, which is what they've done?
It gets much more expensive to buy a house.
It gets much more expensive. And so now I'm in the position where I own a house and I'm actually quite keen to sell because of debt, divorce, and death. And you're the buyer, and you're very, very keen on my house. You love to buy it, but the mortgage person is saying, "But Jack, even on your salary, you can't afford to pay that amount of money." Now, you could a year ago, but you can't today. Now, yes. What happens? You're absolutely right in your description of the housing market. I sit here and I say, "Well, I'm not going to cut my price. I could have got 5 million for it last year. I'm not going to accept 3 million today. Don't be stupid. I'm just going to wait." And then it goes to 2 million, and then it goes to 1 million, and then I say, actually, I need to get the heck out of this, and then I sell, and that's when the market. So it exactly goes up, it plateaus, and then it comes down. It's a very sticky thing. So house prices don't tell you a lot about affordability, but they do tell you that you've got a problem coming along the line.
That's a really good point about housing. And it's interesting to note that the Federal Reserve has not let a single mortgage-backed security roll off of its portfolio without buying it back, net. Yeah. It has only tapered its purchases. Next week, Wednesday, I think, June 1st, it is set to begin its tightening, letting mortgage-backed securities roll off of its balance sheet. And already, despite the fact that not a single mortgage-backed security has been rolled off, net, mortgage rates have still doubled from 2.5% to 5%. How much do you think the market can take
Well, can I just pick you up on a word you used there? Tightening.
Please.
Tightening. Excuse me, but we're not tightening. We're starting, perhaps, to normalize. The last time that we were writing about this in the last report, the last time that interest rates were 8.3%, or that inflation was 8.3%, we were at 10% interest rates. 10% interest rates, 8.3% inflation. And we're tightening with maybe going up 25 basis points or 50 basis points, or even shock horror, 75 basis points. No, we're not tightening. We've got, what's the if we keep in mind the fact that history says at today's level of inflation, we should, if we're trying to control inflation, be at 10% interest rates. Now, what's affordable at 10%? How many homes can I afford to buy? So I think, that we're on a path. And as I say, the crucial number to me is 3.25, because once we go through 3.25, then we know we're back in that world of the 70s and 80s. And we know where interest rates will go at that point. And they won't be going to 1. They'll be going to
3.25% on the 10-year or?
The 10-year, yeah.
Yes. Well, the Federal Reserve, it has, on a relative basis, it has tightened things, right? Where the market is now pricing in something like a 3% terminal rate.
It started, words are important. It started to normalize. Tightening would be if we were at 10% and going to 15.
Yes. So your definition of tight is above R star, above the natural rate of interest.
Well, I'm merely looking back at history and saying this is where we were. We had 8.3% inflation in 1982, and we had 10% interest rates, 10.4, I think it was. So, right. So if we're at 10.4 today and the Fed is tightening, then that means we're going to 11 or 12 or whatever. And that is tightening. They might do that. They might not. Paul Volcker did, obviously. And he's their current hero. But, at today's rate, 2.8 or something today, we're not tightening at all. We're starting perhaps to normalize.
Starting to normalize. Okay, starting to normalize. I would agree with that. Paul, let's move on from housing to chemicals, your expertise, really your bread and butter. So the pH report is not only a great name to way to capture your initials, but it covers the chemicals market, and particularly the pH report. Chemicals, you argue, are a litmus test for the global economy. So if chemical companies are able to pass on high gas and high oil prices onto the consumer of chemicals, the buyer of chemicals, and the price of chemicals go up, that indicates a robust economy. And that's what you were seeing in the late half of 2020, first half of 2021. However, if they can't, which is what you were seeing a month ago when we last spoke, Paul, could be a harbinger of recession. What are you seeing in the chemicals markets? What are the prices doing? What are they telling you?
We're seeing a patchwork now. So we're seeing some areas which are really, really struggling now. One of the main polymers, polypropylene, for example, is really struggling. Polyethylene, on the other hand, which goes more into sort of consumer markets, packaging and so on, is still holding up a bit better. But so what you're saying, what I'm saying is that there isn't a consistent pattern that it's all going very well or it's all going very badly, but some areas have really lost the plot and are going down, and some areas are still hanging in there. So it's a judgment call. But generally speaking, if you look at what's going on and you look at the cries of pain that I hear when I talk to our clients, to companies at the moment, and this is where I think we have to bring in China. Because, Shanghai, one of the world's largest cities, 26 million people, been locked down now for coming up to a couple of months, sold 0 cars in April. Can you imagine a city of 26 million not selling a single car? This kind of tells you that demand has been knocked for 6. And
supply too.
Yeah. Oh, yeah. So what it says is somewhere in the system there is a tremendous hole And as they say, a hole has appeared, police are looking into it. And, if we're the police and we're looking into this hole, I think we're saying, excuse me, we might just step back a bit. That hole seems to be broadening. And, so you've got, because it's not just, Nomura, the Japanese bank, have been doing a survey, and it's been between 325 and 400 million people in China affected by these lockdowns. Shanghai, very wealthy city, Beijing now going into a form of lockdown, the capital city, and so on. So that is going to disrupt supply chains more. Apple warned about this, a month ago. Said, we're going to take a hit of somewhere between 4 to 8 billion because of supply chain problems and so on. I haven't seen anything public since then, but I'd imagine that hit is going to be larger. I noticed that they're talking now about pulling out of China in some areas if they can, and re-establishing in Vietnam or whatever. So there's a lot going on. I noticed that the people who do the word counts for quarterly earnings calls are saying that there's been a dramatic spike in the number of CEOs and CFOs talking about reshoring now and so on. So we know there's some major disruption going on. And what I know about disruption is that it's a bit like, you're on the top of a mountain and you want to get over to that mountain there, but there isn't a zip wire that you just go straight across. That's all right. No, you go down into a valley, you lose all the stuff that you'd had before, and then you have to rebuild again. So, China is almost certainly, people tell me now who live there, is in recession. So Europe is in recession. I just don't see how America can avoid it.
Wow. Yeah, I'm just looking at the Caixin China manufacturing PMI, and it's officially in recession territory.
Yeah.
Tell us why is the Chinese government locking so many people up, or sort of treating them like prisoners? I understand there's the COVID thing, but it seems like in America, at least, Americans protest when there are lockdowns. But is it that in China it's the opposite? When if there's too much COVID, they think that would harm stability? Because it seems like this lockdown policy is extremely, it does not at all support their financial goals, their goals of growth or even stability by any sort. Because this is causing a market crash in China. It's causing an economic crash. It's causing horrible things.
But if you go back, you see, this is the thing about the last 20 or so years, where we've always said, the pie is growing, and so there aren't arguments about dividing it up and so on. What's good for the economy, is the main thing. Actually, most of history, what's good for the economy has been a second or third. So the question for President Xi Jinping, and he's coming up for reappointment for his third term in October or November, and he's gone with zero COVID as a policy. So, China is China, and it's a fact of life that China doesn't like to admit that something it's got isn't very good. So it won't admit that its vaccines are not very good. We all know that they're not very good, and we all know that the solution would be to actually get Pfizer vaccines or Moderna vaccines or whatever and use them. But no, that would be losing face. And so that can't be done. And Xi Jinping has set his stall out on, we had the best record with this, we did the lockdowns, and we're going to continue with lockdowns. Because the other problem with China is that its medical services outside the major cities are only sort of about a third to a half of the population, depending on how you count them, medical services are pretty rudimentary. If you're lucky, you could get a Band-Aid, but you probably can't get an injection. It's that serious because the majority, the rural population, the discretionary spending in China is for people outside of the main cities. It's only $4,000 a year. Disposable income. Disposable income in the main cities, the biggest cities, averages less than the poverty rate in the States. This is not really a wealthy country. This is a country that appears to be wealthy because of subprime on steroids, because of the highest possible multiple for housing prices. And so as long as house prices keep going up, then that's no problem. You can afford to buy the new car and so on, just as we saw in the States. But now house prices are falling and lockdowns are underway and the economy is being hit. So if, President Xi decided that you had to tackle the real estate bubble. He came out with this phrase, homes are for living in, not for speculation. And there's one thing you have to do. He can't lose face. He said, I'm going to tackle the real estate bubble. He can't row back on that. He said we're going to be the best in the world with a zero COVID policy. He can't row back on that. Well, if the economy suffers, well, the economy suffers. That's just the way it is.
What is the current state of the real estate normalization, to use your word? I know in the summer, Evergrande equity essentially went to zero. There were a lot of other subprime construction companies that their equities had been severely impaired. Their debt, their bonds were trading at something like 30 cents on the dollar. Where are we now? Is the Chinese real estate sector anywhere close to sort of the bottom from which it may emerge, or is the deleveraging only just beginning?
You've got house price to earnings ratio in Beijing and Shanghai, are in the top 5 in the world. So they're higher than New York or London. They're in the 40s and 50s. So they're stratospheric. And as I say, that's fine as long as prices are going up, because everybody, you know what banks are like. Banks will lend you an umbrella when it's sunny, and they'll take it back when it starts raining. And that is what we're seeing now in the housing market there. So house prices are starting to fall in most of the major cities. It's a bit hard to know what's going on, because if you're not allowed to leave your home, I mean, I know people living in Shanghai, and only last week were they, after 6 weeks, allowed to actually walk out of their apartment. It wasn't like here that you're allowed out for an hour or something like that, or whatever, and so on. You were not allowed to leave your apartment. I mean, Chinese apartments are not that large to start with, and what it must have been like with young children. I mean, it's just unbelievable, So, and it was policed. There was somebody at the bottom of every. There was a vigilante at the bottom of every staircase to make sure you didn't go anywhere.
What is happening to the employment situation in Shanghai and these other cities that are locked down? It sounds like the situation economically is more severe than it was in March and April 2020 in the United States. And what the United States did paycheck protection program, stimulus checks, furloughs, a lot of income support. Is China going to do that?
No.
Why?
Because they haven't got the system to do it. China, there are very wealthy people in China, and there are some people living at middle class levels, $50,000 and plus levels, as we would recognise them. But the vast majority, 80% of the population, is somewhere below poverty level by an American comparison, and one has to remember that the economy, the housing market in China only began to operate in 1998. There was in 1990, because all property was owned by the Communist Party until 1998, and still all land and property outside the major cities is still owned by the government. So there was, one of the things that struck me when I began to work on this, many years ago, was that it took until about 2002 or 3 for the word mortgage to come into Chinese.
Do you think the PMI, the Caixin PMI, China's Caixin PMI, could go lower than 2020?
Yeah. Oh, I mean, China is not the US. There was this quite extraordinary period, I remember in sort of 2010 or so, where a whole lot of blue-eyed Americans and others visited Shanghai and Beijing for the first time, and they saw these skyscrapers, and they were taken in by what appeared to be, gee, we never knew that China would become middle class so quickly. Well, there was a reason for that. It hadn't become middle class. You know,
What did you say?
I say it hadn't become middle class. You know, and so the problem you've got is false expectations. Now, ordinary Chinese have been used to, you had the Great Famine during Mao's era, where the grain stores were locked. You had the famine. One part of the famine was caused where Mao decided that birds were eating all the seeds, and so he said you've got to stay up all night and you've got to bang your saucepans and so on to stop the birds landing so they don't eat the seeds from the food rice crop and so on, and so the birds eventually all died out, and then you've got, of course, a plague of locusts next year because you had no birds. So this is those of us who've worked in China for a long time know that there isn't a modern democracy operating here with checks and balances. There is what President Xi Jinping wants to do. And one of the things that President Xi Jinping cannot do is lose face.
Paul, to look for a silver lining in what is a very dark sky, do you think we'll have the same thing that we had in March and April of 2020, where everyone is at home and they were buying iPhones, they were buying things that they didn't need on Amazon? Like, could we possibly see could this be a bull market for Alibaba and Pinduoduo because everyone is locked at home and being forced to order stuff?
Well, what I was told this morning by the CEO of a Western company who lives in Shanghai, has been in Shanghai for 8 years, is that the rumor mill says 20% of tech staff have been sacked.
Wow!
So that doesn't imply that Alibaba and so on are coming back anytime soon. The issue that's happening now, and we mentioned it in the PH report, is that the parameter for China has shifted. If you're a Western company thinking about investing in China, you don't anymore say to yourself, if you're sensible, I wonder what we can get out of it. You have instead to say, what's in it for China? Because if you don't do what's in it for China, you won't get anywhere. And you've got to decide, first of all, if we're doing this in order to benefit China, can we make some money from it as well?
Let's move on to electric vehicles. I know China has grand ambitions to become the world leader in electric vehicles, autonomous vehicles. Tell us about how that's been going on, and how does the shutdown across the country affect that? Not just Chinese companies like Peng Auto or NIO, but also companies like Tesla and other foreign non-Chinese electric vehicle manufacturers.
Well, there's two things until we get to that. One of the interesting things that's happening is poor dear VW, who've been the main Western seller in China's market for a very long time, are being squeezed. Because when we had what you might call the boomer super cycle, when you had this sort of constant demand, you developed a middle ground in the market. So you didn't have a sort of divide between a Rolls Royce and a Trabant in the old days of East German, where you didn't have an engine, you just had a floor and you could pedal along, sort of thing. Yeah. So markets were very much divided between high perceived value and low cost. So if you can afford, sort of a fur coat, well, you can have a fur coat, but otherwise most of us just have something to try and keep us warm. And there isn't a middle ground. We had the middle ground. Now, what's happening in the car market under the pressure of the recession is that middle ground is now disappearing. And so poor old VW they're being hit worse. Tesla, interestingly, is not being hit so badly because it's up at the top end. So as long as there are, as F. Scott Fitzgerald said, the rich are different from the rest of us because they've got more money. And so there are still people who can afford to buy Tesla cars, or there are other upmarket. But otherwise, the Chinese companies, the NIOs, the Xpengs, and so on, the Wuling, for example, my favorite car, sells for a few $100 as an EV. These are doing rather well. And so you're getting two changes going on in the market at once. One is a pivot from a middle market to either competing in the up market or the down market. Think also of from the smartphone market. Exactly the same thing happened. Samsung's market share everywhere has halved over the last 3 or 4 years. Apple's still doing okay at one end, and then the cheap Chinese people at the bottom. So that's one thing. The second thing is that what we're really looking at in China is a move to autonomous vehicles. And why do I say that? It's because China can't possibly build a gasoline or diesel engine that will compete with Ford or VW or GM or anybody else. They've been doing it 100 years. It can't do that starting from 10 years ago. So it's not going to try and do it. But anybody can make an electric vehicle. There's no competitive advantage. You and I, Farley and Hodges can go out there. We can ask all the viewers of Forward Guidance to put in a reservation, and we could make money. We get our numbers right on that, because there are very few moving parts in an electric vehicle. There are 20 perhaps compared to 2,000, so it isn't complicated. So if you want to run a brand, if you want to make money, you've got to do something else. And so what everybody is doing, that's in the States and Europe as well as in China, is you're moving to autonomous vehicles. You're becoming a software-based supplier of mobility solutions.
So the electric vehicles are easier to make, only 20 parts, as opposed to internal combustion engines, which require 2,000. You say, how come we see so many electric vehicle companies sputter and fail? They come to market with these bold promises, and then the stocks go from 10 to 110 to 50 cents. How come we've seen so much failure if it's so easy? And what should Hodges and Farley as a company, should we be worried about this? Because we don't want to disappoint our viewers who are going to become drivers of our electric vehicles.
Well, luckily Hodges and Farley have got a theory here, but there's 20 moving parts compared to 2,000. So what I'm saying is your analysis, Jack, as always, is exactly right. That there is no competitive advantage. Any fool, more or less, including ourselves, could go and make an electric vehicle. All we have to do is to buy some plastic, we buy some batteries and so on. There's nothing to it. So how on earth do you build a Warren Buffett moat here? Because there's always going to be somebody, Joe or Jane down the road, who finds a way of doing it $2 cheaper. So people, it's a typical market. We launch, everybody thinks, well, these guys are great. Well, of course we are great. It just happens that we're not very good at making electric vehicles. So you all rush in, you all buy the stock, it goes to 500. We luckily sell at that point because we've suddenly got urgently got requirements. You understand, we're still very committed to the thing, but we just have to sell.
I had expenses, Paul. You have expenses. It has nothing to do with
tuition fees. I can't remember what it was. We've talked about my wife's diamond. She's got insatiable demand for diamonds, so we just had to sell.
It's demand. It's been pent up demand too.
Exactly. If only the viewers would subscribe now to this stock that we're about to issue. Her birthday's coming up. This could be very good news. Maybe we could put a subscription on the web afterwards. But seriously, for a moment, what you're therefore doing, what the car companies are doing, and Tesla's doing this as well. It isn't. Everybody recognises the only way you'll get to have some competitive advantage and some protection is by going to autonomous driving, because that is difficult. Anybody can do level 2. That's fairly simple. Level 3, which people are starting to do, where you're allowed to do it within certain areas, is easier to do, but it doesn't get you anywhere. Who on earth is going to buy a car or rent a car from you if you can only drive it in certain streets in Los Angeles or San Francisco or something? It's not worth. So you've got to get to level 4, which means you've got to be capable in level 5 of actually driving remotely, not only hands off and eyes off, but mind off. That's the way to think about it. So you get to level 4, level 5, and you've seen the videos of Mary Barra from GM doing that in San Francisco. You've seen Herbert Diess of VW doing that in Germany. So it's possible, but they haven't got authorization to do it, and we're 2 or 3 years away from it. But what that means is that you're going to move business model to a pay-per-use, mobility as a service kind of thing. so there's two questions here, or maybe three. First one is, have you got enough cash to get you through this period to when you can start selling these cars, given the competitive pressure that you're under? Because, as I say, electric vehicles, anybody can do it, and certainly costs are going up at the moment, so that's not very good news. The second thing is, can you actually hire the software engineers and get to this new business model? And thirdly, when you've done all that, will the authorities actually give you permission to do it? So there's some fairly big statements that have to be made here. I mean, I could say, if you look at General Motors or Ford, you could say, well, they've got their income from gasoline and diesel cars. That should tide them over. If you say about Tesla, well, Tesla normally relies on raising more funds. Given what's happened to its stock price, will it find it so easy to raise more money next time it needs some? We don't know. It's just an example of a question mark. And if it can't, it goes bust, because it hasn't got, its actual earnings are not enough to support this move to level 4 and level 5 autonomous vehicles. So, but let's give people a pass and say, yes, they probably can survive. Can they hire and retain the IT support they need? Maybe they can. If you say each of these is an 80% chance, and then you do the sums, so it's 80% chance you can keep the funding going for the next 3 years, another 80% chance that you can hire all the software engineers and they know what they're doing, and another 80% chance at the moment that authorities will actually let you do this. 8 by 8 is 64. 8 by 64 is something a bit less. So you've got less than 50% chance of most companies making it. Now, that isn't factored into stock prices. So I'm very enthusiastic about EVs. I'm very enthusiastic about AVs, but I don't think most of the companies around will survive.
Yes, it's kind of like an internet, but where the companies that will survive will be transformational.
Yeah.
So I know you're not super bullish on Tesla. Let's put it that way. What do you make of Ford, General Motors, Volkswagen, Stellantis, the Chinese electric vehicle companies? Because also I was just looking. I found Ford, and its price to earnings ratio is actually something at like 4.5. So there are companies out there that meet the Benjamin Graham equation test of lower than 8.5 earnings. And then also you had a note in your PH report, which I recommend people check out, about why automotive companies are in a very good place right now. What did you mean by that?
If you go now into the new world of investing, away from the Bernanke Greenspan thing into the world of Paul Volcker, therefore you go to Ben Graham, what you're doing is you're looking at the quality of earnings, and so you're forming a judgment about the industry and the management. And that's a judgment. There are no rights or wrongs on this, but and generally speaking, there is a famous phrase which is true, which is, if there's a dispute between the reputation of the management and the reputation of the industry, it's generally the industry's reputation that comes out ahead. So in other words, if it's a pretty bum industry without much prospects, but you get some super managers, they tend to go, they tend to disappoint. So I think that there's a good opportunity for the established automakers here, recognizing, however, that there are two key challenges. One is they have to pivot from their current sales model, which has been very successful for 100 years, which is through dealers. And they somehow have to move away from their dealers to selling online, and to, because what you're going to be doing is you're going to be, as I say, it's going to be mobility as a service. That, fast forward 10 years' time, that's my Ben Graham thing, you're in New York, and what you'll have is a bundle with, say, GM or with Ford, and you'll pay them $50 a month, and that will entitle you to an AV coming to your door and picking you up in Queens and taking you around, downtown. If you want to go up to Boston, you'll have another roaming package. That's one problem. I said there was a second problem. Second problem is that you're coming into the market are the Chinese, and the Chinese are coming in with a very low price model because that's what they do, and they're coming in. They're changing the world a bit in that what they're really looking at, and this makes sense to me at least. They say we're not going to actually supply batteries and charge you for a battery. We're going to do battery swapping. And they've got 900 NEO, for example, got 900 stations. It's part of Chinese government policy now, because if you're going to do an autonomous vehicle, well, supposing you need to recharge it, well, excuse me, there isn't anybody there to take the battery out and swap it over. There isn't anybody there to plug it in. Just how are you going to do this charging thing? If you do battery swapping, well, what they've done is they've built, a system. You have a common layout. So you drive your car into the booth. A minute later, literally a minute later, the battery's been swapped, and that has two big advantages. One is you don't, when you're buying doing the rental, you're not actually paying all the cost of the battery. You're amortizing that. And secondly, you're keeping up to date with the latest battery technology, and you don't have the person. So you've got to make those two pivots in the model, because battery swapping is quite different from a Ford V6 engine, which is what I had to have, but you don't like Ford V6s, you like GM V6s or whatever it is, and so on. So this is where these are the big challenges, and it's always easy, in my view, to look at the obvious things about, can they sell it and is the right price right and so on. Yeah, people knew that. But the real issue is the cultural one. Can you get the whole dealer network to accept that this is what we're going to do? I mean, we've seen in the unions, 400,000 jobs disappear because of going to electric and autonomous vehicles, because nothing goes wrong. You don't need servicing anymore. What happens to insurance, for example? Because Mercedes are trying this out next year. There isn't an individual driver. So we don't get motor insurance, which is a vast proportion of insurance demand at the moment. The insurance has to be from the manufacturer, because if I'm an autonomous vehicle and it hits someone or crashes or whatever, well, it's not my fault. It's the manufacturer. So you've got an enormous number of challenges that you've got to overcome.
Yes. Well, the long-term deflationary aspect of electric and autonomous vehicles is something that you and I have been talking about for a long while. Paul, it's been fantastic having you on Forward Guidance. Thank you so much. People should follow you on Twitter at Paul Hodges1. They can find your writings on new-normal.com. Paul, what's your final message? What's your closing words you want to leave the audience with?
The BBC is a very famous broadcasting organisation, and occasionally gets into trouble. And when it gets into trouble, people use the acronym "Be bloody careful." Sorry for swearing. I think that's my message about the markets. There will be money to be made on the upside and on the downside, but BBC, be bloody careful. This is not the world of the last 20 years. It's the world of your granddad. And, he'll tell you it wasn't necessarily plain sailing.
Wonderful. Well, Paul, thank you so much.
Thank you very much.